I spent many years not making money, and I found after 30 years what it was. And I want to share that with the readers here and the podcast viewers. And believe it or not, I can share that with you in the first 10 minutes of the podcast, exactly what you can do tomorrow when you wake up, go to the computer and make money on actionable advice I'm going to give you. Of course, I cannot make guarantees, but I'll give you advice that it took me 40 years to learn, and I'll give you a program that you can use to help you duplicate what I have done over the years. You'll get that in the first 10 minutes. And I want to emphasize, I'm doing this not to make money. I'm doing this to help people so they don't go through what I've gone through for 40 years losing money and then finally realizing what I've been doing wrong.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field.
Traders, welcome back to the Algorithmic Advantage. Larry Williams suggested that I talk to one of his students, since he's got a public track record of producing over 20% per annum over the last 3 years without any losing months, which had me a bit suspicious, but that is on the Robbins World Cup Advisor website. Now, it turns out that that's just his futures trading, and he also stacks that with his equities trading, which has been producing an additional 20% or so over the last, I think it was 7 years or so. So meaning he's actually taking home about 40% per annum. Now, Michael has been trading for over 40 years, and he started at the age of 19. By 20, he was at Merrill Lynch in their commodities division. That led to the commodities exchange, gaining experience on the trading floor. That led to Lehman's, trading S&P 500 futures, and then FX, doing transactions with counterparties like Michael Marcus, Paul Tudor-Jones, George Soros, and now he manages money for his own clients through Wallace Investments. Now, he credits his track record to Larry Williams and also Ralph Vince, but not his experience on Wall Street. So given it was a suggestion from Larry and the track record and that background, I think that qualifies him for a chat on the Algo Advantage. Now, real quick, let me tell you, I'm so glad to finally be saying that Algo Collective, our membership area, and Algo Academy, our course platform, are finally open. So I apologize for the radio silence of late. Let me tell you, that is about to change. There's been a lot going on for me, but the main thing is that we now have a community. Inside is a free Python for Quants course in backtesting from Dr. Tom Stark, as well as a whole host of other stuff. So the podcast, extra content, of which there's 30 minutes from just this pod alone that we've got in that area. There's the mentorship sessions, weekly live sessions that I'll do, a live buzzing forum, Python auto management system code, extra research and strategies I'll be providing. The list goes on, so check it out. On the course side, I'm excited to say that we have the Crypto Traders Edge course now live, but limited to 50 spaces so that we can really work with the members inside. And I can tell you, I've done the course and I'm now implementing my own fully diversified automated crypto trading portfolio. And it's all thanks to working with David Bush and the CTE course. There's circa 10 hours of content in there. There's 430 plus slides. There's code for TradingView. I've provided code for Real Test. There's around 15 strategies and seriously a whole lot more. I'll talk more about it on Substack, so make sure you're subscribed there. Second, there's the series of 4 courses from Tom Stark on Python for quants. There's probably no better way to learn Python specifically for quant traders than from an institutional quant guru who himself is a Python and trading mastermind, right? So there's not much more I need to say about that. Get on the website to check it all out, algoadvantage.io. Cheers. I want to further introduce this show with a few important thoughts. We covered some very interesting ground, and I think it's fair to call out up front that while everyone is going to be able to pick up some invaluable ideas from Mike, I know that some of the mathematicians and hardcore quants out there are going to pounce on any position sizing logic that doesn't treat each trade as an independent bet or tends toward martingale sizing and so on. But please do remember that I'm not silly. I get that. But I've also been around long enough to know that you can pick up ideas anywhere. And this stuff is really thought-provoking. In fact, I wrote the whole write-up on this pod on position sizing. There's a full write-up with every show, if you didn't know. So you should check that out on Substack or the website. Look, long story short, depending on where you're at with trading, Michael's methods are going to generate different responses and ideas. What it got me thinking about was the behavioral biases that might exist within the world of technical analysis or within the minds of technical analysts that might validate sort of playing the odds in a more martingale way under certain conditions. And if you don't know what I'm talking about, then read the write-up, because position sizing and understanding position sizing is super important. But martingale in trading generally just means that you're kind of doubling your bet after each loss so that you are trying to recover all prior losses on the next trade, which means you need to start thinking about risk management. And that's another critical element of all of this. And so whether you're a card counter at a blackjack table or a trader, you've got to be prepared for worst outcomes, right? So if you are, then potentially that justifies putting your foot on the gas for short periods at certain times. Anyway, we cover some very interesting content, as I said, and with the verified track record, that's always enough to make me sit up and take notice and work out, well, what can I learn here? Let me just frame this with a little bit more of a story for the newer trader, because this is really important and interesting stuff. So there are a few stages of development in trading. The newer trader, and hey, if that's you, you are welcome here. You'll hear a lot about this indicator or that indicator, right? And of course, then you'll hear, well, but you're just not using it right. You've just got to do it like this. You've got to have the 37 and the 26, and this has got to happen like that. And there's this one thing that you don't know. You can spend a lot of time down those rabbit holes. It'll be like, well, you just need to find confluence at the higher time frame, and then you just need to find this, and you just need to find that. So on and on it goes. Then there's like maybe a second phase where you might become a bit more quantitative about it, let's say, and you develop a much deeper understanding of the markets themselves and of probabilities and of doing data analysis without fooling yourself. You could potentially get stuck at this stage for a while too, because you're limited by the tools that you have. You might use TradeStation. TradeStation is a hammer and suddenly everything is a nail. You can't do certain things in TradeStation, so perhaps you never think to ask about those questions. And what can potentially happen there is everyone can end up building the same kinds of strategies. You get a bit cornered by those tools and those constraints. Potentially you don't know what you don't know, right? Let's say beyond that, there's maybe a third stage of master craftsman level where you look beyond the individual indicators, the individual strategies, the individual trades, and you start to see the value in risk management, position sizing, capital management. These can play an enormous role in your profitability. So these other things, if you like, position sizing, capital management, as we discussed in this show, you can take strategies that are very poor strategies and transform them into profitable strategies by thinking about these things. Right. So that to me was the major takeaway from this pod. And we get into a lot more in the members only discussion afterwards. So jump in the collective. You won't be disappointed. Let's get on with the show.
Yes, I think that the first advice is the way you see the markets. The first thing you need to do, it's based on my experience, is that the markets short term, we're talking day, 2 or 3 days, are random, completely random. And we have some evidence that supports that argument that I can present to you. Okay. That markets are somewhat of an illusion. You think you're winning when really it's just randomness that's trending in a particular direction. I've developed a program based on that philosophy that has consistently made me money. Since I've developed that program in 2023, I've traded for 3 years in the Robbins World Cup Trading Championship, World Cup Advisors, with no losing months for 3 years. My whole life changed when I developed this program based on that philosophy that the market short-term are randomness. The second is long-term trading is not random. There is a drift. There is a bias in the market. So you do not approach long-term trading, meaning years trading and investing for people, which I do as a money manager, we completely use an algorithmic approach that we backtest for 60 years that helps us define those entry points and exit points. The short-term trading is a completely different philosophy. So I want to bring the podcast viewer to realize what that difference is. The first thing I can show you on investing is that it's very easy to make a double-digit return most often in a good market. Here's the way you would simply do it. I take technology. Technology is leading companies in the United States and the world is technology. So we focus on that. And based on a technology, let's say ETF like QQQ, you can take, let's throw out a number, $100,000. Typically in a market, in any one given year, the market will correct by 10%. If the market corrects by 10%, typically, not every year, wait for a 10% correction in the QQQ ETF and buy. Now you want to have a margined account. So if you have a $100,000 account, in a margin account, I use Interactive Brokers, you can trade $200,000 worth of QQQ for 100. Now, over the last 15 years, the QQQ ETF has made over a 20% return on average over the last 15 years. We don't know if it'll keep doing that, but I think the growth is there in technology. So let's say if you make a 20% return in the QQQ, if you doubled using leverage by doubling the amount of positions you put on by using a margin account, that 20% turns into 40%. So here's what you can do tomorrow. Wake up, wait for a 10% correction in the QQQ, buy 100% on margin the QQQ when you get that 10% drawdown and hold on. That will most likely give you a double-digit return. Now I use futures to hedge that position, and I create another double-digit return based on that. But that's another form for another day to discuss. But I think we'll start out with actionable advice that you can do tomorrow that will most likely give you a substantial return. Now, obviously, we use algorithms. So if there's a bear market, we get out. Those can improve your return. But just simply buying on a correction of 10% on margin, using the 100% that you get, that will most likely get you a positive return in the market over the long period. And every time you get a 10% correction, try to buy more on the money you've already earned and continue to compound and leverage yourself. That's what I've been doing for 10 years. I've have a return audited by an outside tax accountant of 25%, which I can provide to the podcast. I grew up in that era. I was on the trading floor in New York. I worked for Aldo Rose in the sugar pit. Richard Dennis at that time in the 80s was in the bond pits in Chicago. So I grew up and identified and I followed him. You know, he was extremely successful trader in the pit, one of the biggest, right? But he decided at one point to go off the floor and manage money. And he developed this trend following system. You know, I've done substantial reading and I followed him along. Interestingly enough, trading on the floor, you're like an insider. You know who's buying and who's selling. Back in the day before electronic trading, you know, you wanted to trade bonds, you had to go to the pits in Chicago. So you were the insider. When electronic trading came along, there was no more insider and then the edge was gone. Richard Dennis went off the floor and started managing money. Trend following. Well, the market didn't trend like the 70s because we didn't have inflation in the 80s like the 70s. So he lost 50% of his money and he closed his hedge fund. That's a true story. Okay? Now he developed all these turtles and these turtles went on to do stuff. But I'm saying the foundation of the turtles was teaching people, which is a wonderful thing. But the trader himself who taught these turtles lost 50% of the money and closed the account. I believe that the traders did. I followed them. They went on years after that. And they're now, I believe, not really doing a lot of what was taught because trend following doesn't work all the time. So some of the performances of these turtles, has not been very good. I'm not saying they're not profitable. I'm not going to judge anybody. But, the point that I'm making is that a lot of people said, I manage hundreds of billions of dollars. I must be successful. That's not necessarily true. Just because you manage a lot of money or you're famous doesn't mean you're making money. So for me, the most important thing that somebody that's going to teach somebody is to give evidence that I'm real. I'm not on a YouTube making all kinds of false claims. Okay.
Well, it's very frustrating in the trading world, and that's why I developed the pod mic, because I wanted to speak to people who had verifiable track records. I tend toward trying to find fund managers who are in the public. So, I mean, I was super happy to talk to you because you're not well known. But Larry Williams came along and said you should speak to my student Mike here. He hasn't had a losing month in 3 years, and I've seen your track record. I mean, it's public; people can see it on the Robbins World Cup. I've seen the last 2 years there, the statement from the year before that, 3 years on futures, plus the last 10 years on equities, plus you return stack them, which I want to talk to you about. So when you start stacking those returns, the returns start to accumulate because you're able to use the stock as margin on the futures. I mean, this is really practical stuff from someone who is more able to share, than most fund managers. So this is why I thought it'd be a great chat, which it's proving to be.
Well, my goal here is not to sell anything. My goal is for a trader to start making money, start going in the correct direction instead of the opposite direction. And it is my humble opinion that 90% of the books and courses out there are sending the trader in the wrong direction. It's
100%.
only logical because 90% plus are losing. So if they were doing the right thing, they wouldn't be losing. So my concept, my idea, and I'm very passionate about it, is to set people on the right course with the right philosophy that can make you money. And I learned that the hard way, and I want to help people. And I have the track record that demonstrates I must be on the right path.
Yeah, well, I'm doing the same thing. It's like it seems like we all had to learn the hard way, and there's very few people who actually learned the hard way who are willing to teach a few things. So I think you and I got that same passion there, where we're actually, and the people that I'm surrounding myself with, we're actually happy to help people because it's not necessary to go through the exact same path. I think it's still always going to be hard because anything in life that's good takes some effort, but there's no need to take 30, 40 years to do it.
Well, I want to make the comment that it's very important to understand perspective. When I started when I was 19, I had to pick up at the World Trade Center. I had to take the train, the World Trade Center, and pick up a commodity perspective. There were no computers. I'm going to repeat that. When I started trading, there were no computers, essentially. I think I bought the first Apple IIe computer in 84. But when I started trading in 82, there were no computers, no internet. We picked up commodity perspective chart, the World Trade Center, and I drew trend lines. And by the time I was done, I had ink all over my hands because it would rub off on your hands. That's how it was. The advent of the computer allowed back testing. So many of the years I didn't make money is because you really couldn't back test because we didn't have computers to be able to do this. What is my point? That the trader today has a gigantic edge over the trader in the 80s that I started. So I've lost some substantial amount of time because I couldn't properly back test and just drew lines on a chart, which is going to get you nowhere. So the computer power that we have today, doing the right concept, thinking the right way, puts a tremendous amount of power in your hand that didn't exist when I started. Larry Williams was probably the first to use computers in the mid 80s to really back test and make money, as evidence he won the World Cup trading championship in 87. He was the first to really bring that. And my trading today, I couldn't do without very powerful programs that just didn't exist when we started. So I want everybody to realize you have a tremendous advantage today that a lot of these old timers like myself, I guess I call myself an old timer, didn't have when they started.
You and me
So
both now.
you're lucky. You consider yourself lucky that you have the tools now to do it. You just need the right idea in the right direction, which my intention is to give you.
So, I mean, Mike, just can you give me a bit of that background of learning from Larry Williams and even Ralph Vince? Larry is the guy who put me on to you. So, of course, everyone's going to be interested about what you really learned from the Grandmaster.
Well, Larry Williams, I have to say this, was ahead of his time and still is, was way ahead. He was using computers to backtest. I think Jim Simons, I got to give him credit, one of the best hedge fund managers in the world, was using computers. But Larry Williams is one of the few, along with Jim Simons, that was using computers back in the 70s and 80s to backtest the markets. What I learned from Larry is he wrote a book on Definitive Guide to Futures Trading, Volume 2. Everybody should pick that book up, read the section on money management. It is that section that changed my life and the way I traded. I built a program on that chapter using Larry Williams' programmer that he was kind enough to connect me with. It took his brilliant programmer to run through that chapter and program those money management concepts, which I put in a program. And since I started using, I've had double-digit returns for the last 3 years with no losing months. And I back-tested it since 1993. It never had a losing year. We did out of sample and in sample, and it still, even out of sample using in sample data, it still didn't have a losing year. So it worked in bull markets, it worked in bear markets, but the basis was Larry Williams, that book in that chapter. I follow Larry Williams on our seminars. I've been to multiple seminars, tapes, books, etc. I've known him and followed him all my life. But it was that particular chapter that inspired me to do this because I thought, what great concepts. But he wrote those books in 1989. In 1989, there weren't a lot of programs and programmers around that could program those. My programmer even told me that this took all the skill he could do to program these kinds of concepts. Not easy stuff. So it was years later that I found a programmer, Larry Williams programmer, that had the talent to program what was in his book written in 1989. And I thought that was very interesting. Larry Williams wrote about concepts, but the programmers and the computers weren't really very sophisticated to actually implement it. So I've been looking at that book, staring at it for 20 years. And finally I woke up one day and I said, it's time. Let's act. Let's build something so we can prove, does this work or doesn't it work? I love the ideas, but until I can put it on a computer and backtest it, it's just an idea. So I did that. And it did work. And then I did present that to Larry Williams. So he liked what I was doing, thought it was great. So he's on board with what we're doing. So is Ralph Vince, which is the money manager or the mathematician, I should say, that is behind Larry Williams, involved with Larry Williams when he won the World Cup Championship, Robbins, in 1987.
So, Mike, can you bullet point some of the philosophy that you gained from that book, from Larry, from Ralph, like, position sizing, risk management patterns? What was it? What are some of the philosophical things that the light bulb moments for you there?
The light bulb moment was, well, the title of the chapter, the most important chapter in this book. That caught my attention. Here's a guy who won the World Cup Championship, 11,000% return in 1987. He said, this is the most important chapter. Let me pay attention. The other one, he showed a concept in that book called the slow grind. The slow grind is an approach. It's a money management position sizing method. And he showed the difference between a system with it and a system without it. The same exact trades. It was a pork belly system. It's in that book. Anybody can go back and find that. And it shows that the system without the slow grind lost money. With the slow grind, it made money. That was the light bulb moment, because you could make the argument that whether the system makes money or loses money almost becomes irrelevant. It's the money management behind that created the win, not the system. The system was just the basis to start. It was the money management and position sizing based on probabilities is what actually created the success. That was the light bulb. And once I saw the power of that, that's when I set out to program it. But like I said, in 1989, there was just try to find a computer and a programmer to do that was I tried and I couldn't. I just couldn't. But as the years went on and we got to 2021, that's a long time later, I said the computers are there, the programmer is there, introduced by Larry Williams. I couldn't have done it without Larry. And the programmer Stefan lives in Dubai. That
you've spoken to another very well-known trader and taken some of his systems. You said that had otherwise crashed and burned, and you turned him around just with these money management principles. Is that right?
That's true. The person is Andrea Unger. I wanted to work with him because I felt that it might complement what he's doing. He came to me, he's a very successful, accomplished trader, and he came to me and he said, well, the problem we have is that systems work for a while and then they stop working. He says, what can your money management program do? Can it prevent that from happening? Because if I understand Unger's work is systems that stop working, he pulls from his portfolio. When they're doing well, he keeps them. So I thought this was interesting. The theory is that if we could stop systems from falling apart, then there's no reason to pull them out of the portfolio and put them in, and when to take them out, put them in. You just leave them in because they're always working. Wouldn't that be a wonderful thing if we could do that? He gave me some intraday systems in the DAC, a couple of them. We ran them on the program, and we found a way to prevent the system from falling apart. It continued an uptrend. And I gave that to Unger, and he said he really liked the results. It was very interesting. So we proved, I think, again, that it really, sometimes it's not the system itself. It's the position sizing and the way you play it based on probabilities makes the true difference in the long run.
Mike, you also said earlier most traders, earlier in our discussion offline, are fooling themselves, and 95 or whatever plus percentage of traders lose. You had a chart there. Were you able to bring that up again? Do you want to tell me why traders are fooling themselves again?
I do. And, it's not an easy thing to accept. And I understand that. I hope your readers are just keep an open mind when you listen to this podcast. If you don't have an open mind, you don't develop. You got to have an open mind, be willing to accept anything and see if there's validity before you say, hey, this is no good. This doesn't work. I encourage anybody to go to Google and type in the words coin flip chart. That's it. Coin flip chart. Google, you'll get a bunch of images and you'll see that these images are random.
Can you bring one up? Do you have one there?
Yes, I do. Well, the first thing I want to say, I want everybody to look at this chart and please tell me on this chart, is this a stock or a commodity, and which stock or commodity do you think that is?
Could be any. It certainly looks like a stock chart.
Look at the nice uptrend. Look at the nice head and shoulders top with the breaking of the neckline. Then it pulls back and then finally breaks the neckline again. And then, we go all the way down to a bottom. Yeah.
Uptrends, breakouts, head and shoulders. Higher highs, lower
it's all there.
lows.
All there. Well, the awakening here is that this is not a stock or a commodity at all. It's a random coin flip chart. It's flipping a coin. And you could swear it's a stock or a commodity chart. I mean, you have to look at this and you say, well, if randomness can create this, when I look at a stock chart of IBM or silver or gold, am I looking at something that's happening because of investor sentiment, or is this just simply randomness? And I would say this chart, in my opinion, gives strong evidence that a lot of what you're looking at is an illusion. It looks like there's support here because the market consolidates, but look at the flip coin chart. It consolidates too. Well, what's causing that to consolidate? There's no buyer support there. So it opens up a whole new create a way of thinking that am I looking at buyers buying here, or is this just randomness? And based on my studies, based on the program I developed, based on the results, based on this chart, I could go on and on. The evidence is very compelling that what we're seeing on a short-term basis is strictly random, but you can make money from randomness. And that's been proven in the casinos at the blackjack tables. Watch the movie 21 with MIT students.
And
On
Ralph
and on.
Vince was like, he wrote the book on blackjack, didn't he?
Well, it was Edward O. Thorpe wrote the book on card
Ed
reading
Thorpe.
at
Yes,
blackjack.
sorry, Ed Thorpe. Yes.
Yes, and he got so good in the casinos they wouldn't let him play anymore. He ran a very successful hedge fund for many years, but to me,
One of the most successful. No, I mean he did
yeah,
extremely well. Yeah.
yes, one of the most successful. I think he had 3 losing months in 20 years, some remarkable number like that. We have Jim Simons. He was another one, but probably I give the edge to Thorpe because he wrote Beat the Dealer, and he applied the statistics and probabilities and money management on the blackjack table, and then wrote another book and took it to the stock market and used those concepts in the market and created a great hedge fund. I'm simply just taking those same concepts that he used and applying that in the stock market. I've used these same systems in the roulette wheel in the casinos. I've never had a loss in the roulette wheel, as hard as that is to believe, using this.
Okay, so tell us about the gambling / casino thinking here, and your strategy at the roulette table, and how all this relates to trading, where most of what we see in the market is noise. It's not always easy to find the signal. There is, I believe, some signal in the noise because we are dealing with human participants with a lot of human behavioral biases like fear and greed. And that does tend to show itself, like you said, with the big sell-offs in the NASDAQ. Is a fear overreaction, and you often get a greed overreaction to follow it.
Right.
So, Larry Williams came up early on with some really fascinating ways to sort of play into that by letting those kind of behavioral patterns compound a bit, and I don't want to say it because I think you're going to talk to us about this, but what are some of those gambling principles and behavioral principles that mean we can kind of stack the odds in our favor and press into the wins, particularly when they're happening?
Well, once you accept that short-term price movements are random, you have to accept that. Once you accept that, then it's only logical that the casino is also random, with the odds actually worse because of the house, where they stack it with the house. What the light bulb moment for me was when I saw the movie 21, and they got these MIT students that went in there and read cards and could beat the casinos. So, I mean, the cards are essentially random, but they knew because of counting the cards, they knew which cards were more than likely to come up at a particular, and then they would increase their position size.
Yeah, so they're starting to stack the odds in their favors. They've got a deeper understanding of the probabilities, and whatever small edge they have, they're pressing it with that position sizing. and risk
Well, I
management?
did that in the roulette wheel, and I had a system, and then I used a different form, but it worked in the roulette wheel. And then it got to thinking. That was back in the '90s. I did that with the roulette wheel, and then as like I said, I wanted to program all this stuff and see what it would do in the markets. So we finally got where, I found the right programmer and we had powerful computers. So we finally took Larry Williams' book, Definitive Guide to Futures Trading, Volume 2, on the section of money management. We programmed it. We're basically duplicating what I did in the roulette wheel, duplicating what the movie 21 did with the MIT students and the blackjack, and said, you know what? Let's do it in the stock market. Why not? It's the basic concept was there in Larry Williams' book he wrote in 1989. So I said, if we could just program it and we can do it in the casinos where the odds are against us, in the stock market, the odds are much better. So I felt it should work, and there's no table limits. No table limits. Aha,
Mm-hmm.
So it did it. Fortunately, it did work even better in the markets. I guess it's. And then the other comment I want to make, this is a very logical deduction. If more than 90% of the people are losing, and this is statistically relevant by a lot of the wirehouses have come out with this data, more than 90% of the people are losing. If this is the case, it could only be logical that they must be doing something wrong.
Mm-hmm.
If 90% of people are doing something and they're losing, only logically could they be doing something wrong. So what are the 1 or 2 or 3% doing right? And I humbly believe what I'm doing is the concept that creates wins, because most people don't do it.
Do you apply these concepts both to your equities and the futures trading, or are we talking mostly around these futures strategies, and your equities tends to be a little more investing focused and has some different systems, and then you stack them later? Because you are an advisor, so you're managing people's money. Obviously, you've got a strong risk management and investor mindset as well. How does it all play together?
Well, what I like to do, let's take $100,000 account. We invest in an ETF, for example, and we invest for the long term. We're investing, when I manage in a retirement account, it's very conservative. So we use very long-term algorithms that we back tested to trade in and trade out, signifying when there's a bull market, when there's a bear market, when we should step in, when there's a panic to increase our position, these kinds of things. Because there's a very long-term trading. And I want to emphasize, this is not random. Long-term investing is not random. I think we know that statistically that the stock market since 1929, I believe, is up over 10% a year on average. So that's a long history. So you would say that really can't be random. There's a drift. So long-term investing, there are algorithms that I've developed for that, but that I feel is truly investing. But what I'm referencing to randomness and statistics and probabilities is short-term trading. When we get into day trading, intraday trading, trading for 3 or 4 days, a swing trade, that's randomness. But year to year, 2 or 3 years out, that's a completely different approach. So what I've done is I've combined the two. So I will invest $100,000 and it'll be a margin account, and I'll buy an ETF based on our algorithms. And I'll have I call it my hedge program, which is the futures based on statistics, probabilities, and money management. Since I typically buy in weakness on those programs, because that gives you the edge. If I'm buying weakness in the stock market, there's a little bit of an edge there. So I'm looking for edges. So when our stock positions start to fail, then the hedge program kicks in the futures to offset those losses in the stock positions. So if I'm gaining 20% on average in the futures, I'm gaining 20% on average in the stocks, I'm getting a good 40% plus return when I combine both of those.
So you're very much
you know.
You're very much return stacking there, in the sense that the stocks can also double as margin for the
Correct.
futures positions, right?
Yes. Yeah, we use that $100,000 account. We can, of that 100,000 invest in stocks, 50,000 can be invested in futures. Okay, because it's considered cash commodities. So we get up to 50%. But since future contracts are leveraged, you don't need as much. So we'll tap into that 50,000 margin to buy the futures, which is usually buying on weakness, but based on probabilities and money management, offsetting the losses in our stock positions.
So you've kind of designed it from the beginning to work like that as a hedge, or did it just sort of work out that it naturally is a good equities hedge?
That's a good question. It was designed as a standalone trading system. But since I look for edges, and edges were are buying weakness in the stock in NASDAQ, I thought, well, why not? When I started looking side by side, I said, wait a minute, this seems to be complementing our stock portfolios. As weakness in the stock and you get a pullback, this hedge kicks in and offsets those weaknesses. And we might have an 8% correction in the stocks, but we get that 8% back in the futures. So it eliminates or almost eliminates a lot of the losses. It took me a minute and I realized that and I said, wow, this is like a hedging program that is always on. Because the biggest problem about a hedge is, when do you put it on? When do you take it off? If you use options, there's a cost because options premiums decay. So you got to measure the decay, how long you have the options, when to put it on, so this creates a whole nother set of problems. What's nice about this hedging program is just always on. So you have your stocks, you have your hedge, it's always on. You can just let it play. And as the market corrects or there's weaknesses, typically that hedge then will kick in and just so your viewers know, the back testing of this hedge program, the futures program, we back tested since the inception of the SPY, 1993, is 89% accurate. 89% of all trades are accurate. And they're day trades, by the way. You're in and out, close to close. 89% accurate. Never had a losing year since 1993.
And this is the program you've been running live. So 3-year track record with Robin's World Cup, doing extremely well as well. So it's hardly a hedge because it makes money in its own right. So it's the ultimate hedge. It's a profitable hedge. And so it's short-term trading. And what kind of instruments is it? Is it just a couple of futures contracts, or are you trading like a diverse range of commodities and FX and so on?
You could. The program was developed to trade anything, but I typically trade the E-minis and NASDAQ because that's most of my stock portfolios. That's what we're trading. So I try to offset the stocks. So I use futures to offset that. So primarily the E-minis, the S&P E-minis and NASDAQ is what we're trading. But I mean, you could trade gold, silver, crude, you could trade anything. But I still think, and Larry Williams taught me this, you always want to go with biases. Find the biases. Larry teaches us, find the day of the week that's a bias to be up or down. Find the market that tends to be up. So I learned from him to try to focus on biases. So when you're trading the E-minis, S&P, there is a bias there for the market to go up, not down.
So is it long only, or is it long and short? Because it sounds like it would be short.
It's good that you said that. Long only. We never short.
Right. So that's even more fascinating and unusual, right? So it's a hedge for stocks as they're falling, but the futures strategies are long only. They're buying for a single day. So being a bit of a mean reversion guy myself, I take it that means that you're buying the sort of bumps up, the sort of short-term up reactions as the markets are falling.
Yes, but it's based on high probabilities that will happen.
So tell us a bit about stacking those probabilities, those patterns in your favor, and what you've learnt from Larry there.
I've noticed that all systems tend to do the same. They get in large drawdowns over a period of time, and then eventually they recover. So there's a period where they work, then they get in large drawdowns, and then they kind of snap back. And this is kind of a typical trading system, regardless of what system it is. Now we're talking short-term trading system. If you look at the long-term graph of my portfolio, that's 89% accurate. There's something striking about it that you don't see in any other, or I have seen in any other performance reports, that the drawdowns are only maybe 2 or 3 days. They're very, very short term. They don't go on for weeks or months or years. They'll go on for a few days, at best, a few weeks. So they're very short-term drawdowns. So that's very appealing by using what Larry taught me, by using a money management style based on probabilities. You can cut out those long drifting drawdowns where you're just negative, losing and losing and losing, because that works on your psychology, right? Another trade, you're losing again. That's not, it's not a pleasant thing. So we don't normally have that. If you're winning 90% of the time, your drawdowns, if we haven't had any losing months for 3 years, so on a month to month, there is no drawdowns. But in a trade, you will have a small drawdown, but no month to month. We will get losing months. I mean, the system does have losing months, but not very often. But what I learned from Larry is that, that approaching the market this way improves the performance, the odds, and the drawdowns, which can be so psychologically difficult to get through. And let's face it, somebody gives you their money and you say, well, I can make a 200% return, but you might have a 40% drawdown. Well, the client's going to come to you and say, well, how do I know that I give you my money on Monday, you're not going to just be the start of a 40% drawdown? This is a real problem for money managers because you don't always know when this drawdown is going to start. So a long adverse drawdown when you get a new client or when you start trading is a really devastating thing. And that's what increases this risk exponentially. But what if I told you I have something where you don't get, 40% drawdowns? On a month by month basis, the system doesn't normally have any drawdowns. If it is, it's very minor, very small percentage, maybe 7%. So I have clients and I know traders that will say, hey, I'd be willing to sacrifice return for less risk. I don't need to make 200%. Yeah. I'll make 30% with virtually no drawdown than risk losing 40% of my money and 100%. So, and this is what Edward O. Thorpe, who wrote to Beat the Dealer and Ran a Hedge Fund. He only lost 3 months in 20 years, I believe is the number, something close to that. His drawdowns were very small. His returns might have been 25 or 30%. But I think consistency, low drawdowns, and consistent profitability has more value than high returns and higher risk.
Yeah, so I think when we talked offline, Mike, and if you're happy to talk about this, just let me know. But I was thinking of the other Larry Williams principle as well of waiting for losing trades to accumulate before piling in on or increasing the odds that the next trade is going to be a winner. Is that part of the philosophy?
Yes, that Larry Williams called that the pendulum effect. That let's say you have a method you've back tested. Could be a moving average, a system buying an RSI, stochastic, could be any kind of method. Typically, let's say this system is 60% accurate. You've back tested over 20 years, it's 60% accurate. Okay. Larry's concept was, well, what happens when the system is now only 30% accurate over the last 10 trades or 20 trades? Logically, there is a better chance that the system's going to mean reverting. It's going to, their odds are piling up that it will more than likely see some more winners than losers. And in true actual trading, that is what happens. So we developed a program that will measure trading systems when, say, out of the last 10 trades, they're only operating at 20% or 30%. And then it does the simulations in the background. And when it finally meets that criteria, then you'll get a signal to start trading it. And when you combine that with 3 losing trades in a row, and then it's 30% over the last 10 trades on a 60% system, you really start building probabilities on your side. And in reality, and that was the reason I developed the program. Larry
Mm.
Williams said this is what happens in his book in 1989. But
Mm.
I wanted to see empirical evidence that this happens on a computer for going back 20 or 30 years. So we developed a program and we back tested, and it is true. Not only is that concept valid and works, but there's an interesting add-on or bonus to it that Larry Williams also explained, and I've always been fascinated in it. Let's say you get a system that is normally 60% accurate, but has now only operating at 30% accuracy over the last 10 trades, and we've had 4 losing trades in a row. When we finally get that winning trade, statistically, the winning trade is much larger than normal. It's
Mm.
like the system is playing catch up. It's like a rubber band.
Mm.
You've
Well,
pulled and
the
pulled and
human
pulled.
emotion is kicking in. They've had a few losses. They don't want to lose anymore. The fear of missing out, FOMO kicks in. So everybody's all in at once. I can see the potential human behavioral economics behind that kind of thing.
I'll be honest, I don't know why it happens. I just know when something's lost for a long period of time, when it finally wins, it seems to win
Big.
more, not proportionally, it wins substantially more. Uh,
Mm.
I've seen that consistently. Larry Williams wrote about that. And we've seen that in actual evidence, which is a fascinating concept.
Mm.
Think about that.
Yeah. So it's a form of trading your equity curve, I guess. So you're running the system in the background and you're monitoring the trades, but you're skipping the initial couple of trades, or you're focusing on the trades that occur after a losing streak, say.
I want to say one important thing where a lot of traders go wrong, and I've learned this the hard way through pain, lots of pain,
Mm-hmm.
is that there's a tendency to say, "Oh boy, I'm making money. Let's trade more positions." You don't want to do that. You do not increase your position size because you have more money. Because
Mm.
what you'll find out, and this is through back testing on our program, that you'll be trading your largest position right when you get your worst drawdown, and you'll lose money twice as fast than you made it.
Mm.
This has happened time and time again to me in real trading. Then I developed a program and I back tested it, and I found out, yeah, here the
Mm.
way we circumvent that, we'll look at the pendulum method I explained, series of losses in a row, and we'll say now is a good time to trade. But if we're ever going to increase position size because we've made money, we don't do it because we've done well. We do it when we're doing badly. When there's
Mm.
an equity drawdown, I have another algorithm in the money management program that will only position size, increase the position when we have a certain drawdown historically. Once we get that drawdown, we'll increase our position size until there's an equity high. Once there's an equity high, then it goes back to the original position again. So we have a number of variations of that. This is critical because if you increase your position size as you make money, you'll get a drawdown and it'll all be lost back again. And, so you don't want to do that. It's been my experience.
Has Ralph Vince and his education influenced your position sizing logic?
Yes, Ralph Vince developed Optimal F in his book, Mathematics of Money Management. He was the mathematician behind Larry Williams that worked with him in the 1987 World Cup championship with Robbins. I know him. We speak. I've read his books. he would actually like to come on this podcast with me.
Let's
And
get Ralph on. That'll be awesome. Yep, we'll get Larry on as well, hopefully.
yes, well, they're, yeah, having those two would be great to complement what they're doing, 'cause it's really based on their works. And
Mm.
one of the programs we have in the program I developed is Ralph Vince's Optimal F. It's all there, the Kelly ratio, Optimal F, all kinds of variations of it. So all the systems I mentioned with the pendulum and losses, you can pile that on top of when to increase your position size based on optimal F. And then we developed, that's a strategy by strategy level that we can put in a portfolio. We have, 100 strategies in a portfolio. But I went one step further. I told the programmer, what if? So he developed a whole set of money management algorithms that we have on a strategy level, we have on a portfolio level. So if we wait for 3 losses in a row to trade a system, the portfolio with 100 systems could wait for 3 losses in a row, no matter what system it is. If there's just 3 different systems have 3 losses in a row, the portfolio would actually trade. So it's a whole nother layer on top of the strategies we have a portfolio level. So it's quite something, but it's a whole new way of looking at the markets, trading the markets that's not available anywhere else. I haven't seen any other programs that could do this. I looked and I couldn't find, so I built it.
Mm.
Yeah.
How frequently do these futures strategies trade? Are they trading even when the markets are doing well? Do they only turn on in sort of bear markets, or if they're always on, are they taking multiple trades a day, or on average like a trade a day? Like how sort of high frequency are they?
I have a portfolio that simply uses daily data. I buy on the close, sell on the next close. Typically, we're very selective when we trade. I think out of 30 systems in my portfolio, we trade between 2 and 3 trades a month. But the program is set up for many markets. I'm only trading 2 markets, by the way. But you
Yeah.
could trade multiple markets and generate more trades. You could trade intraday and generate more trades. So there's no limit to what somebody could do using the program. I just haven't had enough time to sit and continually develop programs to trade more. I'm pretty satisfied with what I've got. It does well, doesn't overtrade. But I could do more. If I had more time, I know I could do a lot more with it. I just
How
lack.
does how I'm just curious, you say you trade 2 markets, so I guess that's like the Nasdaq and the S&P 500.
Yes.
And how did these systems backtest out over, say, 2008 or 2020, COVID, other crisis years like that?
That's interesting, and that's what I noticed when I look at the data going back, that the system, since they buy typically, not all the time, but typically on weakness, because that's where the edge is in the stock market. In '08 and 2020 in the bear markets, the systems did better, which was kind of encouraging because I know your stock positions do worse because you're holding. But a lot of times you can't sell a stock position because of tax problems, right? You can't sell because of capital gains issues. So you got to hedge. So this hedging program is always on and does better in bear markets because why? You get more signals because you get more weakness, so you get more signals. So it actually works better in bear markets, I'm pleased to say. Thank God. It's a nice component.
Did they fire yesterday? I think it was like the 20th of January 26th that we just had a huge sell-off and then we had a huge rebound. I think today, 21st or maybe.
Yes. So we got a signal in the NASDAQ to buy on the sell-off. That was one of our trades. It was a high probability trade. We had a big update today, I'm pleased to say.
That's awesome.
So I do have to add one of the add-ons to the probability is if we do have, let's say today were to be a loser, we would wait for another signal on the same system and then increase our position size on the next trade. The concept is that we know that we had a high probability trade, but we know that if we lost, the odds typically are better next time. So we increase our position size on that next trade. And this is really foundational because that's the whole point. You want, and Larry says that in his book, Definitive Guide to Futures Trading and Money Management. You want to increase your position size as the odds are better for your position. As they're worse, you decrease. That's the whole concept. That's how they win at blackjack at 21. They increase when the cards look better, they decrease when they don't. That's really, it's that simple. And this is a very important point to get. A lot of people I see, including me, and when I started trading, I would increase my position size as I made more money, which is exactly opposite what you want to do. You got to know the odds of tomorrow's trade, and then you increase based on those odds accordingly with a mathematical formula.
So, Mike,
Larry,
just square that with me with the statement that you made before about, you said, you don't want to increase your bets. Like, if you keep increasing your bets, you'll have your biggest bet when the market has its worst sell-off, you said earlier.
yes.
So that's about adding capital. And whereas now you're talking about, just correct me if I'm wrong, now you're talking about having a set of strategies or a portfolio that has a certain position sizing logic such that, it's kind of sizes smaller initially, and then, for trades, or as trades go against it, or as you have a few losing trades, then you start to increase the position size. But I guess it's all, am I on the right track so far?
Yes, the key distinction is not based on do we have more money. It's based on what is the probability of this trade. This is a really important distinction because one works and the other doesn't. And but the key to this is you got to know the probabilities of the next trade to know when to do it. And I suspect that most people probably don't. I mean, I sure didn't, unless I have a computer program that tells me that. But unless you have a computer program that is set up in such a way to tell you that, you don't know. So by knowing that, that's the most important number to have. That will tell you when to apply the money. And again, if we do apply money to increase our base position size overall on all our trades, we have another program for that. We usually do that when there's a drawdown in the overall portfolio. We buy when we're doing bad, not when we're doing good. I think markets are fascinating. They work in reverse psychology. What instincts feel you should do the opposite will probably be the right thing. Yeah.
So just talk to me about risk management then on these positions. So let's say we're buying and we're getting bigger position sizes as potentially the market moves against us. What's your risk management around just a real catastrophic, like 1987, things continue to sell off and don't stop?
Typically in something like this, we look at the historical runs on these systems with this algorithm applied. Once we get outside of some historical event, we would probably, depending on the situation, stop trading. We know over a long history what this should be doing. We may go one trade beyond historic, but at some point we have to say things are not lining up with history and we just get out. The other event is if we see some chaotic event in the market, any like I guess a pandemic would be a good example. This is a major news event that disrupts market movement. Normally, we try to stand aside on something like this because you could get a black swan event. We don't need to be trading in these markets that are not normal. Now, in our investment accounts for my clients, I went in and bought Carnival Cruise Lines and JetBlue. These were valuable companies that will come back, and I bought when everybody gave up on them and they were sidelined. So we would do something like that in an event in our stock portfolios. But in our futures trading based on statistics, probabilities, we stand aside. Standing aside probably is the best risk aversion that we have.
So you'd say that you build these systems, you're definitely a systematic trader, but would you say you've got like a 5% discretionary overlay? Like if the excrement hits the propelling device, then you're willing to just take some manual decisions and exit, things like that. Is that where your discretion would kick in?
Yeah, I would say there is some discretion in an event, like I said, a pandemic, a 2008 financial crisis. I think most traders will tell you in some world catastrophic events, a lot of people, it's best just to stand aside. Pretty much that's the only time. I think in the 3 years that I've traded the futures program, I think we went out beyond historical norms one time in 3 years. So it's a very rare event that we would even get that, even have to make a decision.
For this trading that you're running through Robbins, is that fully automatic? Have you got that fully automated with systems, or are you manually placing those trades?
Those are automatic trades. And anybody that goes on the site and sees my record, K Wallace Money Management, it is any negative months you see there is not negative from trading. That's negative from subscription fees. Robbins charges, I think, in my account, $250 a subscription fee. So if there's no trades for that particular month, there still is that $250 subscription fee. So the way it's formatted, it will show a negative, but that's not from trades. It's from a fee that Robbins trades. But in actual
Really
trading on my, interactive brokers, I manage money for my clients. There are no losses in those months because there's no monthly fees we charge our clients.
Mike, I think I might leave it there for this round. We can leave people to come back for more because there's probably a bit more we can talk about.